General Interest Deduction Limitation Rule, understanding net interest expenditure deductibility under corporate tax law. Under the UAE corporate tax law, businesses are allowed to deduct interest expenditure from their taxable income as part of the process of calculating taxable income. However, the amount of interest that can be deducted is subject to certain limitations, primarily governed by the General Interest Deduction Limitation Rule. This rule aims to limit the amount of net interest expenditure that can be deducted for tax purposes, particularly in cases where businesses incur substantial interest costs. What is net interest expenditure? Net interest expenditure refers to the difference between the total interest expenses incurred by a business and the interest income derived during a given tax period. If a business borrows money and incurs interest costs, but also earns interest income, the net interest expenditure will be the balance of these two figures. If the total interest expenditure exceeds the interest income, the business will have a net interest cost, which can be potentially deductible. For example, if a company pays AED 100,000 in interest on its loans and receives AED 30,000 in interest income, the net interest expenditure would be AED 70,000. This amount would generally be considered as part of the business's expenses, potentially reducing taxable income, subject to certain rules and limitations outlined in the tax law. The General Interest Deduction Limitation Rule. The General Interest Deduction Limitation Rule applies when the net interest expenditure exceeds AED 12 million during a tax period. In such cases, businesses cannot automatically deduct the full amount of net interest expenditure. Instead, they are subject to a cap on the deductible amount, and the business must calculate the deductible interest based on one of the following criteria. 130% of EBITDA, earnings before interest, tax, depreciation, and amortization, for the relevant tax period. EBITDA is a measure of operating performance, which excludes the impact of interest expenses, taxes, depreciation, and amortization. To calculate this limit, the business must adjust the EBITDA figure for the period to account for net interest expenditure for the relevant period, depreciation and amortization expenses that have been deducted in calculating taxable income, interest income or expenditure related to historical financial assets or liabilities incurred prior to 9th December 2022, the date the corporate tax law was published. 2. The de minimis threshold of AED 12 million, which represents the maximum amount of interest expenditure that can be deducted without any limitation. The business can deduct the higher of these two values as the allowable net interest expenditure for the tax period. Treatment of Islamic financial instruments. For the purposes of the General Interest Deduction Limitation Rule, Islamic financial instruments, such as murbaha or ijra agreements, that are economically equivalent to conventional interest-bearing instruments will be treated as interest for tax purposes. This ensures that Islamic financing structures are treated in a similar manner to conventional debt financing when calculating the net interest expenditure. Carry forward of disallowed interest expenditure. If the net interest expenditure exceeds the deductible limits for a tax period, the excess amount will be disallowed for that period. However, this disallowed amount is not lost. It can be carried forward and utilized in future tax periods, up to a maximum of 10 tax periods. This allows businesses to claim deductions for interest expenses that were previously disallowed, provided they continue to meet the necessary conditions for carrying forward the interest expenditure. Exceptions to the General Interest Deduction Limitation Rule. The General Interest Deduction Limitation Rule does not apply to certain entities or activities. These exceptions include banks. Financial institutions such as banks are exempt from the General Interest Deduction Limitation Rule as they operate under different regulatory frameworks and structures. Insurance providers. Insurance companies are also exempt from the rule, as they have their own set of regulations regarding interest deductions. Natural persons, individuals who conduct a business or business activity in the UAE are not subject to the general interest deduction limitation rule. Additionally, resident persons who are responsible for or facilitate the provision, maintenance, or operation of qualifying infrastructure projects are also exempt from this rule. Qualifying infrastructure projects are defined as long-term infrastructure projects that meet specific criteria, including: the project is for the public benefit of the UAE. It provides essential services, such as transport, utilities, education, or healthcare, within the UAE. The project's assets cannot be disposed of at the discretion of the relevant entity. The assets are expected to last for a minimum period, example 10 years. The project's assets and its interest income and expenditure must arise within the UAE. The project must meet any additional criteria set out by the Minister of Finance. Such infrastructure projects are exempt from the general interest deduction limitation rule when it comes to financing costs related to the project. When does the general interest deduction limitation rule not apply? If the net interest expenditure for a tax period is below the de minimis threshold of AED 12 million, the general interest deduction limitation rule does not apply. This means that businesses can fully deduct the interest expenditure incurred in the tax period, subject to other applicable rules under the corporate tax law. Additionally, financing arrangements made prior to 9th December 2022, the date of publication of the corporate tax law, may be exempt from the limitations imposed by the general interest deduction limitation rule if they meet the conditions outlined in Ministerial Decision No. 126 of 2023. Example: application of the general interest deduction limitation rule. Let's consider an example of how the general interest deduction limitation rule works in practice. For the tax year ending 31st December 2025, CLLC had revenue AED 150 million, adjusted EBITDA AED 130 million, profit before tax AED 60 million, net interest expenditure AED 50 million, interest expenditure AED 80 million, interest income AED 30 million. Under the general interest deduction limitation rule, the maximum deductible amount is 30% of EBITDA, AED 39 million, which is greater than the AED 12 million threshold. Thus, CLLC can deduct AED 39 million, with the remaining AED 11 million carried forward to future tax periods. For the tax year ending 31st December 2026, CLLC had revenue AED 200 million, adjusted EBITDA AED 180 million, profit before tax AED 140 million, net interest expenditure AED 20 million, interest expenditure AED 80 million, interest income AED 60 million. Since 30% of EBITDA, AED 54 million, exceeds AED 12 million, the maximum deductible amount is AED 54 million. CLLC's net interest expenditure of AED 20 million is fully deductible, along with AED 11 million carried forward from the previous year. Taxable income for 2026 is equal to AED 140 million, AED 20 million, AED 11 million is equal to AED 129 million.